Good morning, everybody. Great to see you all today. I'm Sharon Bedford, a business tax partner here at James Cooper Creston, and it's my great pleasure to welcome you all to this webinar. I'm going to be joined today with a panel of my partners, all who are tax experts. So not as to crowd your screens, they will turn their cameras on and off when they're speaking, but just to briefly introduce them. We've got Alex Nicholson and Phil Snell, who are business tax partners, Stephen Barrett from our private client services team, and Meera Raja, who's our head of indirect taxes. Well, what a week we've had. First of all, we had a mini budget that really wasn't very mini at all. Then there's been press coverage to keep up with, Bank of England announcements, IMF statements, not to mention the Labour Party conference. Clearly, we now know that the currency markets didn't respond well to the Chancellor's announcements, but the success or otherwise of the measures will perhaps only really be tested by the passage of time. Whether you're an individual trying to balance your family finances, or a business owner or senior employee trying to make decisions against a backdrop of uncertainty for your trying to just work out what to do, it can all seem a little overwhelming. So what we are hoping to try and achieve today is to temporarily put the macroeconomics and politics to one side and focus on some of the more tangible announcements in the budget. I'm going to briefly recap on these first. There's a few slides, but hopefully not too many. And then I'm going to bring in the panel to discuss what these changes really mean to you and what tax planning might look like now after the announcements. So if you can have the first slide, please. So I think perhaps the announcements that grabbed most of the headlines has been the changes to personal taxes. And interestingly, some of these were pre-announced anyway, because we knew that, as part of the leadership contest, that this was very much on the cards. But just to briefly recap, the basic rate of income tax is going to go down by 1% from next April, and that's 12 months earlier than was previously planned. Perhaps more of a shock, though, was the removal of the 45% rate of income tax, again from 6th of April next year, and we'll talk about that a little bit more in the panel discussions that follow. I think what we were more expecting was that the 1.25% increase on NIC that came in April this year would go. I guess there was a little bit more debate as to when that would be, but we now know that that's going to be from the 6th of November. And equally, the 1.25% health and social care levy, which was going to come in from next April, is being scrapped. You may recall that because some people remunerate themselves via dividends rather than taking a salary, what had happened is they'd also put the dividend rate up by 1.25% to mirror the NI changes, and that's also going to go. Although interestingly, that isn't from the 6th of November, but not until April next year. And the combination of those means that the top rate of dividend tax from next year will go down to 32.5%. And when you think that that's currently 39.35%, that's quite a big drop. And again, we'll have a chat about that as this webinar continues. Can I have the next slide, please? There's also been some tax changes that have impacted businesses. Again, I think we all knew that the rise in corporation tax from 25% next April probably wasn't going to happen, and that was confirmed in the mini budget. Also, there were some announcements relating to capital expenditure and how you got tax relief for that. The annual investment allowance, which has fluctuated up and down for a number of years, and is 1 million at the moment, but was going to go back down to 200,000 next April. It's now been confirmed that the million will be extended indefinitely. There has been some small changes to the capital allowance super deduction, or we expect there to be, and again we'll talk about that in a few moments. To mirror the reduction in employers' NIC, there's also been a reduction in employers' NIC. I think when everyone was talking about the 1.25% increase in NI, it was easy to forget sometimes that was sort of double that, in that it was both the employees and the employers had a 1.25% increase. And so I'm sure it will be welcome to most businesses that is now also going down. So the current rate of 15.05%, which actually has only been in since April this year, will revert to the prior level of 13.8% again from the 6th of November. Probably of narrower interest, there have also been a few tweaks to the Seed Enterprise Investment Scheme, or SEIS. This will be certainly of interest to some of you, and what this does is it gives tax incentives for very small companies to get investment in, and for the people that are investing in those companies to get some tax breaks. That has been the limits on that have been expanded. Previously, a company could only get £150,000 in that way. Now that's gone up to 250, and it used to broadly apply to companies in the first 2 years of trading, and that's been extended to 3. There's also been a few tweaks to the company share option plan. As a firm, we do a lot of share option planning. Typically, smaller owner-managed businesses would go for the enterprise management incentive or the EMI option plan if they can. That's probably still going to be the case, although for companies that don't qualify for that and have to instead use the CSOP, the relaxations will be welcome. And also, there's been some changes, and again we'll talk about these in a little while, to the off-payroll working reforms. This is for people who, when you don't, instead of having employees, you use people by consultants, and Phil's going to talk about that a little bit later. Can we have the next slide, please? Just a few other measures. I think it's been headline news about the removal of bankers' bonus cap. We're not going to discuss that in any great detail today. What sent like last Friday, some really welcome changes to stamp duty to SDLT, effectively trying to stimulate the housing market if indeed it needed stimulating, by reducing the threshold, increasing the thresholds of when people will start paying stamp duty. Interestingly, I suppose the reflection on that is the reaction to the budget and the potential changes to interest rates. Whether that will have been an effective policy measure or not, I guess only time will tell. Not much in this budget on VAT or duties, but a couple of things noted there. We'll talk about those in a little bit more detail as we go ahead. Not much detail yet, but some ideas, I suppose, to create some new investment zones, which will have 10-year tax breaks, and probably not of wider interest, but certainly of interest to those of us that work in the profession. The Office of Tax Simplification has been abolished. Interestingly, on that, they said they're going to pass the mantle for simplifying taxes back to HMRC rather than having this independent body. But I've had a long career where tax simplification has been talked about for many years, and I've not really seen much. So let's see what happens there. Anyway, that's a really quick just recap of some of the main announcements that were made. So what I'd like to do now is to move to the panel. and to pass over to them to have some debate, as I say, on what these things mean. Before we do that, though, we'd like you to ask for your participation, if that's okay. We have a poll question which will be on your screen shortly if it's not there already. We'd quite like you to vote, please. You can do that on the right side of your screen. We'll give you the results later on. You should see the question, but if in case you can't, it is: the next general election is scheduled for 2024. By the time that comes round, do you think that the perceived gamble the government has taken in the mini budget will pay off? A, yes, B, no, or C, don't know. Please can you vote now? Thanks everyone, and as I say, we'll let you know how the voting went a little bit later in the webinar. Right, so I'd like now to bring in Alex Nicholson. And Alex, I've got a question for you, please. Whilst the mini budget is been helpful for business in that it's, as we said, potentially reduced the costs of taking on staff by reducing NIC and abolishing the health and social care levy, do you think that that will help your clients sufficiently with their rising costs? And what, if anything, would have been better?
Thanks, Sharon, and good morning to everyone who's listening. Well, I think, Sharon, as you say, this measure is undoubtedly helpful to businesses, and especially so for those that have larger payrolls. I think just to try and give it some context, I was just sort of trying to research some figures around it. And the Treasury believe or state that this measure will benefit 920,000 businesses to the tune of an average tax cut of about £9,000 each in 23-24 tax year. So it is quite significant. Do I think it will do enough to help with rising costs? Well, of course, it's not the only measure that's been announced. One of the big rising costs for businesses, of course, are energy costs. But there's a separate package of measures that's been announced around that. However, I would say I certainly don't think it does do enough to help with rising costs, especially probably given the market or the turmoil in the markets and the exchange rate, etc., that we've seen since the mini budget on Friday, which will no doubt be causing a headache for many business owners up and down the country. So I think the sort of issues that we see within our client base at the moment actually came home to me when I chaired a Solent sort of business summit fairly recently, where we had a number of local business owners there. So the issues that they were citing, were, as I've already alluded to, rising energy costs, runaway inflation, and supply side challenges were also mentioned by a number of businesses as things that were causing them a real headache in terms of actually getting stuff into the country and in order to be able to sell it. I mean, generally, though, there was quite a degree of optimism amongst those businesses. That was pre the mini budget. I don't know whether they would say the same thing now. But I think one of the points that, at the risk of drifting slightly, away from the question, but one of the other points that they were raising was that the changing political landscape was a concern to these business owners. And I think so what we're probably now seeing with all the turmoil that has come through in the market is the importance really of stability in government and an understanding of the markets and how government can impact on that. All businesses owners know that they need to continually adapt in order to survive, but they need to be able to plan ahead. And too much change, I think, is not necessarily good for business. Would I, what could have been done better? I don't know whether, I'm not quite sure necessarily what would have been done better in this regard. I mean, I think one thing that did come home to me again through that summit was there were quite a number of businesses there that were actually sort of looking to invest in their own energy security. So they were looking at solar panels on the roofs of their factories and such like. And so I think, although there's lots and lots of energy measures in the mini budget, I think a lot of that seems to be aimed at the country sort of nationally going forward in terms of our future sort of energy security. But from a sort of pure sort of tax incentive for business, I think it would be nice to see something that encourages businesses and gives businesses tax breaks to sort of invest in on-site sort of solar and other renewables. I think that would be really sort of welcomed by lots of businesses. So I think that's probably enough of an answer on that one, Sharon. So I'll hand back to you.
Okay, thanks, Alex. Yeah, that's some really interesting observations there. Thank you. Right, I'd now like to bring in Stephen, our private client partner. Stephen, a question for you, please. One of the things we're often asked by our clients is whether they should remunerate themselves by salary or by dividend. Have you got an answer to that now? And also, given the announcements in the mini budget, might that change from April next year?
Yeah, thank you very much, Sharon, and good morning, everybody. I rather fear the question is broadly the same as we asked on many occasions in the past, and the answer is broadly similar as well, and it is that it depends. But if we have a look first at some of the specifics, I've put up there a slide which just shows how the dividend rate is changing next April. And I've put that up really because as a reminder, because I don't think those rates are quite as ingrained in the psyche as the normal income tax rates. And it just highlights the difference that you pulled out earlier, Sharon, the difference in the tax rate once your income exceeds 150,000 gross with effect from next April. So I think there are two questions really. One is a dividend better than a bonus or the other way around? And the question then is when to make the payment. So could I have the next slide, please? If we just look at the position in the current tax year, and I've taken as an example a company with a profit of £250,000. We have looked at other levels of profit and dividend and salary, and they basically all point to the same outcome. But in this example, I've assumed that profit, and that's after deducting a salary of £8,000 for the purposes of generating retirement benefits. If that were to be fully extracted as a bonus, the tax cost would be around £126,000, including NI and tax. I put an asterisk against the NI because we're still awaiting some of the detail in exactly how the transition will work in November when the NI rate is reduced, but I don't expect those figures will fluctuate significantly. That compares with a total tax cost as of a dividend, if the full net of corporation tax profit were to be extracted, of about 111,000. So quite a significant difference. So the what, as you might expect, still seems to be in favour of dividend rather than bonus or salary. Could I have the next slide, please? The next question is when. And I think if we look at the tax position on the same assumptions in the current tax year, the tax payable would be around £64,000 that would need to be settled in January 24. But if all of that, if that were the only income in the year, so working all the way through the dividend rate bands, the tax charge, if it were deferred until after 5th of April next year, would be £58,000. So quite a significant difference in the absolute tax. And of course, there is a tax flow advantage in that the tax needs to be settled 12 months later. And if there isn't a dividend in this year, then there isn't a payment on account to make next January on account of 22-23. So it looks it looks quite sensible to delay it if possible on these assumptions. There is a question from a practical point of view, of course, though, is the individual may need the cash. And so we've looked at what the position would be if that 202,500 were to be drawn as a loan from the company to be settled by a dividend following 5th of April. And the official rate of interest for calculating a benefit in kind on a beneficial loan from a company is just 2%. And so when you work that through on that figure, you end up, once you've added that benefit onto the salary, you still remain within your personal income tax allowance. So there wouldn't be a tax charge. there would be a small national insurance charge, which we think could be around £300. But when you take into account the difference in income tax by delay, that actually doesn't skew the equation significantly. Of course, I'm looking this, Sharon, from an individual's perspective primarily. There are, of course, company tax issues in advancing loans. And I think I'd like to invite Phil just to add a few comments on that side of the equation.
Yeah, thank you, Stephen. And so I think from a company perspective, the key aspect of thinking about loans is we have the anti-avoidance rules known as loans to participators. Those rules effectively look at whether or not you've got an outstanding loan at your accounting at the end of your accounting period. And to avoid paying a temporary tax charge on that loan, it's important that it's repaid within 9 months of the end of the accounting period. And therefore, certainly for December and March year ends, I think there's a good window of opportunity to be able to defer that, like Stephen says, in terms of using a loan mechanism, provided that loan is then cleared post year end. I think the one thing to note that we see quite often is that people will quite often, in Stephen's example, loan themselves the whole 200,000, ignoring the fact that when you come to declare the dividend later, when you declare that dividend of 200, there's a tax liability that then is attached to that. So you either need to think about being in a position to gross up the dividend so that it nets down after tax to the 200, or when you borrow that 200 from the company, that you ring fence and put to one side the tax liability that will arise on the subsequent dividend.
Yeah, thank you very much, Phil. That's really helpful. I guess I would just close, Sharon, if I may, by saying, going back to my original answer, which is it depends, and this will depend on a whole range of personal circumstances, etc. So before any such decision needs to be taken or made, it's best to take suitable advice, I think, because it looks a simple question, but in practice it's quite fiddly. Yeah,
great, and that's great advice, Stephen. Thank you, and thanks, Phil, for your comments too. Right, we're now going to sort of bring Alex and Mira in, because the next question potentially has both direct and indirect things to talk about. So one of the stated aims of getting rid of the 45% income tax rates, and of not bringing in the increase in corporation tax rates to 25% that was expected last year, was to encourage more investment into the UK. So I'm just interested, and Alex, first from you, your thoughts on whether you think those two measures will help in that way.
Thanks, Sharon. Well, I think it's not surprising, is it, that the reduction in the additional rate of income tax is the headline that, of course, has received a lot of negative press. And I saw a couple of days ago that it was even commented on by the IMF as being something which, you know, would not help equality in this country. I mean, setting that sort of aside, I mean, it's fair to say that it is undoubtedly a significant tax cut for higher earners, and that's anyone, as we've said, that's earning more than £150,000 per annum. However, I think that measure itself, and one of the things that seems to have been a bit overlooked in the press, that actually it's tiny really in fiscal terms. I mean, I saw one bit of commentary and said it's a rounding error really in fiscal terms, and that's because, again, referring to the sort of figures that were published by the government alongside the budget, the actual cost to the Exchequer is expected to be somewhere in the region of about £1.5 billion on average for the next sort of 4.5 years. So fiscally, that measure alone is not significant. I think to answer your question, the point I make about the measure, and indeed, of course, the much more significant, in fiscal terms at least, cancellation of the planned increase in corporation tax, is that the UK, you know, has to compete on a global scale, on a global stage, sorry. So, you know, retaining the lowest tax rate, corporation tax rate in the G7 is significant. And as I understand it, you know, our top rate of income tax, when you combine it with the sort of national insurance, etc., was also not particularly competitive compared to various other sorts of leading jurisdictions. So, you know, I do think that these measures taken together, you know, will enhance the attractiveness of the UK PLC basically as a place to live and to do business. I do have one caveat to that though, and it's quite a significant one, I think, which is that we've only got up until December 2024 before the next general election, and Labour have already come out and said, we'd reverse the planned rate, the reduction in corporation tax, we'd reinstate the 45% income tax rate. So given that Labour seem to be ahead in the polls at the moment, there seems to be a significant uncertainty really over the longevity of these provisions, which could well undermine their effectiveness. That's my sort of current feeling on it. So on the one hand, yes, I think it makes us more attractive, but B, I think everything else that's kind of going on more widely means that, are we going to get a decent run at it to see whether it's actually going to achieve what it set out to? I don't know, is my answer to that. So I think that covers off those bits. But Mira, picking up on a different aspect then, there was also the proposed tax-free shopping scheme that was announced. Do you think that's going to bring much benefit to the UK?
Yeah, thanks, Alex, and good morning all. Yes, definitely. I think it'll encourage the overseas visitors and tourists to come in, knowing that when you do buy goods in the UK and where you're going to export into their luggage, then they will still get a 20% refund. And I think when it was abolished, I think it was a surprise to many international visitors because they all benefited from it. We do have some certain outlets and certain department stores and certain goods that where international people do like to come and shop in the UK. So yes, I personally think that will definitely encourage visitors to come in and make use of that scheme. And also what is being said is that they're going to make it much more less stressful in terms of paperwork. So there's no paperwork as such, everything's going to be done digitally. So that should really help the retailers and also the visitors to make it much more easier to get this refund back. And also, when you think about it, if you're going to spend like £120 on a good, and you know that you're going to get the £20 back, they may go and spend that on a restaurant, on a theatre. So it is good for the UK economy. And also it will encourage people to come in knowing that they're going to get £20 back on the goods that they want to buy and take it back. So I think it's a very positive thing. Having said that, we haven't got the date as yet when this is going to be, they're going to reinstate from, but overall, it's a very positive message for international visitors.
Mm-hmm. Thank you both. Yeah, I think, just a reflection on that, the region that we all live and work in, it has, traditionally been one that has had a lot of UK visitors and also a lot of UK investment. So I hope you're both right, and it does help and encourage growth within the region. Right. Changing the topic a little bit now, you remember from my slides I talked about changes to tax relief on capital expenditure. And Phil, I wonder if you would give us your thoughts on whether you think those are helpful.
Yeah, definitely. So within this mini budget, there were some notable changes. Equally, there were some things that we're still not completely sure as to whether or not there might be further announcements that have been announced that may come in the November. And starting with what we know then, it is still currently intended that the super deduction will end at the end of March 23. So this super deduction was the ability to obtain tax relief on qualifying expenditure for plant and machinery, so computer equipment, through to vans and commercial vehicles. And that was at a 130% uplift over the original purchase price. And based on that, it's still likely that there's going to be a significant advantage to accelerate that expenditure to the period prior to March 23. Now, like everything with tax, that's not just as simple as that. And one of the aspects of those rules is that to the extent that your accounting period straddles that 31st of March 23 date, so for example, if you have a 31 December 23 year end, Based on the current rules, for expenditure that is prior to that March 23, the uplift is restricted on a time apportionment basis. So to use a September year end, for example, if you have a September 23 year end, you have 6 months prior to March, 6 months after. So rather than receiving the whole 130% uplift, it would be restricted to 115%. So using that as a December year end, there is actually more of an incentive to try and accelerate it into this calendar year rather than waiting until January to March for that expenditure. The other thing that we now know is that the temporary annual investment allowance that was previously $1 million, but due to reduce back down to 200,000, will remain at 1 million. Despite obviously some of the uncertainties like Alex mentioned around what might happen in the future, as currently drafted, that is now a permanent change, which is hopefully good for business in terms of trying to give them some more certainty towards this. The final point to note in respect of this is that there is a consultation running in respect of reform for capital allowances and the capital allowance regime. We're waiting for a response from that, and that again could be part of the autumn budget in November.
Thanks, Phil. I think there's some very useful tips then about the timing of when you might want to spend on capital within your business. So yeah, some great advice there. Thank you. Staying with you, Phil, do you mind if I ask you another question? Changing the topic a little bit. Personal service companies, the dreaded IR35 that is often floated around. There's been some changes announced. Can you explain what those are and what that means for businesses?
Yeah, of course. So I think most people are familiar with the IR35 rules. This is a situation whereby, as the end user of an individual, there is now an obligation for certainly larger businesses to determine whether or not that individual should be deemed to be an employee because they have the traits of someone that looks and feels like an employee, or whether they are genuinely a consultant. The rules that were introduced in 2017 for public sector bodies such as the NHS and councils, and then in 2021 for private businesses, did create significant inconsistencies both across sectors within, even within advisory firms, and definitely increased the complexity and risks for the end user, so the end organization of that individual in question. So I think for both the 2017 and the 2021 rules in this mini budget have now been or will now be repealed. And I think that will be a significant boost for many businesses. Equally, I think it will be quite frustrating. There are a number of businesses that will have put in place processes and controls designed around those rule changes that will now no longer be relevant. And I suspect that a lot of businesses will have also spent a lot of money trying to deal with those rules and to apply them consistently. So removing these rules and repealing the 2017 and 2021 rules does wind back the position to what existed previously. So in other words, we now find ourselves in a situation whereby it's the personal service company that is now responsible for dealing with the IR35 rules. So this is by no means a complete repeal of the rules. The rules do still exist, but it shifts the onus back to that personal service company. So if you as the business owner are making use of consultants, it does significantly reduce the risk in terms of engaging with a personal service company. I do think there are a couple of quick points to note. One is that this only applies to situations where you engage with a personal service company. So if you've got consultants that are self-employed and just acting as individuals, then the obligation is still on you to determine whether or not you consider them to be self-employed or an employee, and then to apply the rules appropriately. And finally, I think that it's important to note these rules don't change until 1st of April 2023. So we find ourselves in this sort of unusual period whereby we know that these rules will no longer apply. But I think that we should all be mindful that the revenue could still come and challenge you based on the current rules.
Okay. Thanks, Phil. That's really helpful, and I think it's it is an area. I think one of the dangers could possibly be that people think, oh, IR35 has been relaxed, I don't need to do anything. And I think the flavour of what you're saying is no. The way you go about it might change, but there are some risks there that businesses still need to think about. Thank you.
Yeah, agreed. And I guess I would add there are probably two situations actually where you still can't use a personal service company. The first is in respect of directors and office holders. So if you're a director or an office holder, you are deemed to always be an employee, and therefore you should always be subject to employment taxes. And therefore, this can't be used as a mechanism for a director. So whether that's CEO or COO or any other kind of statutory director to make use of these rules. And the other one is a bit more of an interesting topic, which is if you've gone through the process of considering whether someone is an employee or not, and you've deemed them to be an employee under these rules, and you've therefore brought them onto payroll, I think businesses need to be really careful about reversing that decision. Mainly because of something called corporate criminal offence. And effectively, this is if you are facilitating tax evasion, then you could fall foul of those rules. And clearly, to the extent that someone is deemed an employee, but you then go through an exercise to allow them to potentially reduce their tax bill by operating again through a personal service company, does need some care. And therefore, I don't think this is going to be a overnight, let's reverse every decision that businesses have made.
Okay, thanks, Phil. If I can bring Stephen back in with you now. A question. Following the budget, is it a good time to invest in property? And if so, how should you go about it?
Yeah, really good questions, Sharon. The world is very volatile and fluid, isn't it, at the moment? And I think if we step back before we look at tax and think that people thinking about investing are going to be in different situations, are going to face many potentially conflicting demands. On the face of it, if the housing market is losing value, it may be a great time to invest. It may be a great time if you're a cash buyer, but if you're looking to borrow, it may not be such a good time as you've highlighted earlier, changes in interest rates. I think families will also find lots of competing demands for their finance. If I think as a parent, how much more we may need to support our own children on their cost of living. So there's quite a big piece around this in terms of whether it's a good time looking at an individual's particular circumstances. But focusing really on residential property, there's a slide come up which I think just highlights the key parameters and things we need to think about. The stamp duty threshold increase for residential property, on the face of it, makes it look more attractive. It can deliver a stamp duty land tax saving of up to £2,500 per property. So even if you're buying in bulk, as it were, which some people are considering, that can be per property under multiple dwellings relief. The same rate will broadly apply to a company so long as the company is using the property in its rental business. In that case, the same rate will apply, plus the normal additional 3%. That automatically applies to companies. But for an individual, the 3% only applies if it's an additional property. But of course, in most cases, if you're buying a property to invest, you probably already own your main house, so that 3% will apply. So in terms of whether it's best as an individual or as a company, it's probably from an SDLT point of view going to be broadly neutral. We then really come down to the same considerations I think we've always had, and that is, am I better paying lower rates of corporation tax by owning it through a company or paying higher rates of income tax by owning it directly? And I think that comes back to how much of that profit you're going to need to extract and what the tax cost of that will be. You know, it might be a very different equation if you're a cash buyer and you can lend money into a company to shelter profits at 19% whilst withdraw loan repayments out of company income against your loan without any tax. You know, that might present an opportunity. Whereas if you have to extract the profits in order to fund your personal living, that'll be a different equation. Similarly, when a property is sold, there's the same question of this potential layer of double taxation as the company pays tax on its profit and then you extract it personally. Of course, Phil, we are seeing increasing use of companies as a longer term investment holding vehicle, aren't we? And perhaps it might be sensible to bring you in at this point just to talk about that in a little bit more detail from a corporate and structuring point of view.
Yeah, exactly. And I think, Stephen, you make a good point about the dual layer of taxation. I think that's the big one that a lot of people typically miss when they think about setting up through a corporate vehicle. And I think there's a piece around scale as well. I think that if you've got a single investment property, you've got to weigh up the additional cost associated with running a company, preparing annual accounts, preparing a tax return, and therefore certainly companies start to make more sense as the scale of operation and the scale of or the number of investment properties starts to grow. I think, like you mentioned, one of the key things we'll be thinking about inheritance tax planning and kind of longer term planning around, should you be the only shareholder of the business, particularly if you've got to a stage in life where you potentially have adult children who could also be involved in the business. And we see that fairly frequently now, that it is used as an opportunity to try and encourage the next generation in your family to get involved. And equally around an education piece, being able to encourage those kids and your the more junior members of the family to get involved in running a business and understanding what that looks like.
Yeah, and I think there's potentially more flexibility with a corporate structure than with a personal ownership structure when it comes to passing assets. It's certainly something we work increasingly with clients on as an alternative to trusts, really, in terms of the company's flexibility and the scale that you've referred to, because trusts have a pretty well an inbuilt limitation on what you can do with them without immediate inheritance tax charges. So Sharon, in reply to your question, it all rather depends again. But and in terms of we really, it's incumbent on us to sit down with our clients and talk through the wider piece and also the longer term objective in terms of what tax might trigger when and how that might be mitigated.
Yeah, no, that's really helpful. So thank you both for that. Staying with you, Stephen, if that's okay. We've been told that, you know, from tax terms at least, people are going to be better off from April next year. Is there anything that we should be doing now, though?
Not a great deal, I don't think, Sharon. I'm giving this quite a bit of thought. And one thing that does occur to me is the 45% tax rate is disappearing. Can we take advantage of it before it does? Now, we've been looking at income and deferring income into a lower tax regime. Of course, if tax rate is going down, you want to take advantage of tax reliefs at that higher rate before 5th of April. So the two things that occurred to me were potentially pension contributions to take a benefit of the additional 5%. That can put you slightly in conflict with your dividend strategy because you need earnings to support your pension contributions. But that's a question of working through the numbers and doing some modelling. With pensions, you also have to take account, if you're an additional rate taxpayer at 45%, you may have your annual allowance tapered, but then there might be relief brought forward. So that's quite an interesting sort of process to work through. I think the other point might be around high earning businesses which haven't yet had their 2022-23 accounting year end, or who might be prepared to change their accounting year end, to advance revenue expenditure to prior to 5th of April to secure tax relief in this tax year at 45% rather than at 40% next year. That then becomes partly a commercial decision, doesn't it? Because if that's advancing costs, that might itself have a negative impact on the business. So it's working these things through in the round, I think. But those are the two things that occurred to me.
Thanks, Stephen. So things to look at, but just to echo, it won't be the same for everyone. So you know, good to get individual and specific advice.
Yeah, I think we're really lacking the silver bullet, but then that's always been the case, hasn't it? Yes.
Thank you. Right, now I think now might be a good time, I think, maybe to have a look at the results from the poll question. So if you remember, we broadly were asking you to let us know what you think about by the time of the next general election, which is in 2024 as it stands at the moment, of course, whether you think the government's gamble will have paid off. And interestingly, more than half of you, so 66%, say no, you don't think it will. So not the greatest vote of confidence there, I guess. 19% of you still sit on the fence, not quite sure one way or the other, and only 15% think yes, the gamble will pay off. So anyway, we'll see. Time will tell, as I said before, but yeah, but quite interesting that to take a flavour of the people on this call and to see where they're currently thinking. Right, we now have some time for questions from the audience. So if I could ask you please to type them in the box on the right hand of your screen. Anything you'd like to ask the panel, we're all here for a little while and can please do ask, and we'll do our best to answer them on the webinar. But whilst we're waiting for you to do that, I've just got one final question for our panel. His Majesty's Government, and I had to say that because it's the first time I've said it, have suggested that they want to go further than the announcements that were made in the mini budget to make the UK even more competitive. What would you, panel members, like to see? I'm sure there's lots, but if I can restrict you to one answer each, please. Alex, do you want to go first?
I think a measure I'd like to see, it's not necessarily one that makes the UK more competitive internationally, but I'd like to see the threshold at which child benefit is withdrawn raised. And the reason I say that is because currently child benefit is withdrawn for those with incomes above 50,000, and by the time you get to 60,000, it's gone completely. And I think that impacts very much on the so-called sort of squeezed middle. And it's been at the same level since it was introduced probably about 12 years ago now. So had that threshold been sort of moved up in line with inflation, I don't think child benefit would be withdrawn until people earn between 60 and 70 something thousand pounds. And I think for me that's a measure which I think I'd like to see the government address.
Thanks, Alex. Mira?
I would like to, what I would like to see is like on more tax incentives for environmentally friendly goods and services, like for an example, lower VAT rates on purchase of electric cars, since we are all trying to be more environmentally friendly, and I think that would help many. Because at the moment, when you go and buy an electric car, you pay the same VAT rate as a normal car, any petrol or diesel cars. So yeah, I would like to see VAT reduction on an electric car, and also generally more tax incentive around environmentally friendly goods and services.
Thanks, Mira. Very, very current topic there, and yeah, I think that echoes a little bit what Alex was saying about that's very much a theme that we see coming from our clients. Stephen.
I'm going to slightly echo Alex in the sense of we think about and talk about people with less income and the higher earners, and it's the squeezed middle really. I mean, it's interesting to look that over the last few years there's been a 50% increase in those liable to the 40% tax rate. And those are people who wouldn't necessarily you generally consider to be particularly wealthy. And I'd like to see the higher rate threshold increased to give some further assistance there. Of course, I was slightly banging the desk when the Chancellor was up thinking, why isn't this coming? And this week I'm thinking, crikey, I don't think that should be done because we need to wait for things to settle down. But hopefully post OBR and the statement in November, and when we get to the spring budget, there might be scope to do that. But we will see, won't we?
Yeah, good. And last but not least, Phil?
Yeah, I think I was kind of focusing on potentially, certain industries. So if you take the retail and leisure industry, I think that they're going to have a difficult winter ahead when you look at the, significant increases in energy prices, despite the government help, wage inflation, potentially the additional borrowing costs that they might need to kind of look at. So when you combine that with a contraction in consumer spending, if we do start to head towards a recession, I think that's a really difficult industry. So in the short term, there's some definite help coming through this budget in terms of the changes to the national insurance, corporation tax, for example. But I'd certainly like to see more help for that industry, and I suspect that probably is in the form of some help around business rates again.
Yeah, thanks, Phil. So some interesting ideas there. I'm sure, if we did a poll of everyone on the call, people will have their own thoughts and ideas, but certainly there seems to be a lot more that, the government could do. Right, we have had some questions coming in now. So I think probably starting with the first one and probably one for Mira, please. And this is a little bit tongue in cheek, but is my Prosecco going to be more expensive or cheaper?
Okay, sorry, Sharon, this is going to be another it depends answer, I'm afraid, because the excise duty is going to be, duty will depend upon the strength of the alcohol. So rather than in the past, it's been still or sparkling and all of that's been removed. So it's going to be on the strength of the alcohol. But if the excise duty is lower, this will immediately benefit UK wine producers and the importers, but the retailers may not pass this on to the public. So that's why it depends, because if the retailers don't pass that on to the public, you may not see a difference in the price. But if they do pass it on for the, where they are paying lower excise duty on, yes, your Prosecco might be cheaper. But this is an immediate, if the excise duty is lower especially for the UK wine producers and importers, this is an immediate good news for them as it starts from the 1st of October this year. So it depends, I'm afraid, whether you may or may not have a cheap Prosecco or champagne. Oh, right. But I'm hoping the retailers will pass this on to the public.
Yeah, let's hope so. We'll need something to cheer us up, I think.
Cheer us up, yeah.
Okay. A question now that I'm going to direct to Alex, if that's okay. Does the panel have any insights into whether business asset disposal relief, which of course previously was called entrepreneurs relief, is likely to change?
My personal view is that it's unlikely to change under this government. The reason I say that is we've already seen significant tinkering, well, more than significant tinkering with it in recent years. And of course, it used to apply to lifetime gains of up to 10 million, and it's come down to 1 million. There was lots of fear a couple of years ago that it would be withdrawn entirely. I don't think that's likely. So I think, what we've got currently is likely to be retained. I suppose the wider question there is whether actually it could be improved further. That is a possibility, I suppose. But let's not also lose sight of the fact that so far, at least, there's been no changes to wider capital gains tax rates. And of course, those remain very attractive compared to income tax rates. Most business disposals, if they don't qualify for business asset disposal relief, will still only see tax at 20% on any gain compared to the top rate of income tax, as will be, of 40%. So it's still half the rate and very attractive. So I personally, I don't think it'll be withdrawn. It could be enhanced, but it still remains attractive. I mean, I don't know, Sharon, whether you've got anything further to add to that.
Not really, no. I think that's the message, my own feelings and watching these things. Like, I do suspect it's here to stay, but then, you know, who knows, if we got a change of government or something, then yeah, anything could happen. But some useful observations there. If I could just stay with you, Alex, for a second. We mentioned briefly about these new investment zones. Do you know if any of those are going to be locally, or and what being an investment zone might broadly mean?
I have had a look at a little bit of the detail on that. I mean, I think, because I was sort of immediately interested, really, I suppose, to know whether any of the businesses in our geography, which, as most of our listeners will probably know, you know, we're predominantly in the Thames Valley and the South Coast, whether any of our businesses might benefit. And I think actually sort of looking at the areas that have expressed interest in having these investment zones, you know, they're predominantly up north, as might be expected, but it does actually include Southampton City Council. So you know, potentially there is some benefit if that were to go ahead. I think in terms of what it means, of course, many people will be aware that the Solent already has the Freeport, and that's various sort of designated tax sites that benefit from you know, different or enhanced tax reliefs. Really, it looks as though the investment zones builds upon that and expands upon it. So it could be that within the Southampton City Council there are some extra zones that benefit from these tax breaks. But just to sort of very quickly summarise what those sort of tax breaks are for the enterprise zones, they are pretty attractive. So you know, they should help to sort of pull businesses into investing in those zones, because they're getting 100% business rates relief for a number of years. I think probably it's 10 years. Phil was talking about capital allowances earlier. They get enhanced capital allowances at a rate of 100% on plant and machinery. They're able to write off their, you know, if they're building new buildings, they're able to write off the cost of that much quicker than companies outside of investment zones. So they'd be able to write that off for tax purposes over 5 years. There's STLT relief for, you know, acquiring land and buildings within these zones. And also there's no employer's national insurance on, I think, salaries up to the higher rate tax threshold, which is just over 50,000. So I think, you know, they will help to generate growth where they apply. Will they benefit businesses in our region? Probably not particularly, would be my view.
Thanks, Alex. So just time for one more question that's come in, and I'll just answer that. So, do the changes to corporate share options make EMI less relevant? Again, with the general caveat that everyone's been making, that you know, it depends and you have to look at your individual circumstances. I don't personally think that will be the case. EMI, which is available for smaller businesses, broadly, there are other limits as well, but broadly, companies that employ less than 250 employees are very flexible. They give generally better tax breaks to the employees than do the CSOP schemes, and therefore I think they will certainly remain relevant and widely used. As I said a little bit earlier, the changes to CSOP schemes are good, are welcome, but I think mostly it will be a benefit for those companies that don't qualify for EMI. As I said, it does depend a little bit, but certainly that is my initial thought. Right, so just a summary then. I think hopefully listening today, you will have realised there's a lot to think about and a lot to plan for. We're living in uncertain times, but we do seem to have a new government that is, rightly or wrongly, committed to making brave moves when they feel they are needed. For those of you that follow BBC Online, you'll have seen perhaps that they've unearthed a photo of our new Chancellor when he was on University Challenge in 1995, where he was actually part of the winning Trinity College Cambridge team. So if you forgive me a pun for a moment, maybe this minute budget is only his starter for 10, and there is more to follow. In fact, as we've alluded to today, we already know that there's going to be an additional fiscal statement in November, this time with a report from the Office of Budget Responsibility and another full budget next spring. So there's lots to watch out for. Here at James Cooper Creston, we're very committed to keeping you informed as matters evolve. So please do watch for invites to other events like this. Both the panel members speaking to you today and all your other James Cooper Creston contacts will be delighted to discuss any matters with you arising from the mini budget or otherwise. It just remains then for me to say thank you to all the panel members today. I think you've given us some really useful insights and lots for everyone to think about. And also to say thank you to all of you who've joined us today. Enjoy the rest of your day and bye-bye.